Hello and welcome to another episode of our podcast. I'm your host Shravani. So, to set some context for today's episode, we've all seen how markets have rallied and reached all time highs, especially the mid and small cap categories. Their fund returns have been almost double digits. So, this has led investors to think that this performance might continue and this is the new normal. So, this brings us to a very crucial investment truth. Past returns do not guarantee future wealth. And to help us break this down, to separate hype from reality, we have our founder and CEO, Mr. VishalDhawan. So, he's been studying the markets and the market cycles, investment behaviors since past several years. Hi, Vishal, and thank you. Welcome back to the
Thank you so
episode.
much. Nice to be here again.
Yes. So, Vishal, let's just kick things off with something that's been on every investor's mind. So, they've seen the markets rally, their portfolios give returns, outstanding numbers. So, they just simply expect this to continue. So, what do you feel? How are these expectations normal? Are they realistic, or are investors just setting themselves up for disappointment in turn? What do you feel about that?
So I think we all need to be mindful that investment markets are one thing, and we as investors and human behavior can sometimes just get and behave in a particular manner. So one of the things that's very very common is what is called extrapolation bias, which is that whatever has happened in the more recent past, we assume will continue. A lot of people also call it recency bias. And essentially, because you've had a great 5 years post-COVID on equity markets, there is an assumption that this is now the new normal. And this sort of continues to be the assumptions that we make when we continue to speak. We do find that it creates certain challenges though, because what can happen is that markets can behave very differently from what people expected. And one of the things that I think a lot of investors have not necessarily realized is that over the last 12 months, the Indian equity markets have generally been flat. And if you look at mid and small cap indices, you might find that there might be a small negative return as well. But because the strength of the previous 5 years was very high, a lot of investors are just continuing to believe that equity markets continue to do well. Now, the reason why this becomes a challenge for a lot of investors is that if they need to draw down money from their portfolios during this particular phase, let's say you have an expense come up, maybe it's an education for a child, maybe it's your first year of retirement, maybe it's buying a house, whatever it might be, it essentially means that you will have to actually pull out equity even when it's not doing well. And when you pull that out, that could create what is called irreversible damage, because the moment you pull that money out, you can never put it back again.
Right.
And what then ends up happening is that that loss that people spoke about on paper has now got translated into the real world, and you have a loss which is technically never going to come back from a real perspective. So I think it's very very important to remember that even as markets behave in the way that they have to, on the other side we as investors behave in the way that we choose to, and therefore the balance between these two is what ultimately dictates returns.
Right, great point. But just saying that past returns don't guarantee our future wealth, it doesn't. It just seems like abstract advice to investors sometimes, because unless they understand why we are saying that, they won't be able to believe it or act on it. So, how do you approach this? How do you advise investors to sort of connect to them and understand it and act on it easily?
So I think it's tough because like data very often makes you behave in a certain way, and obviously today there is no shortage of data, and there is a lot of technology that's built on that data as well, which sort of makes you feel that it's quite normal to expect higher than normal returns because the world is different. And one of the things that has gone on forever in financial history has been this time it's different, and every time you sort of talk about it, it appears like there are some things which are different, but unfortunately more often than not history sort of comes back and if not repeats itself, at least rhymes with the past.
Okay.
And therefore it's important to keep that in mind. So I think we need to keep in mind a few fundamental truths. Right? Number one is that over a period of time, as economies become larger, as markets become larger, growth tends to slow down. And this is a normal process. It's a bit like aging, right? So when you get older, it's reasonably normal to assume that you will start to slow down.
Right.
And that's the same thing with growth as well. And therefore, what you need to keep in mind is that some of those past returns that get talked about came in when Indian equity markets were, for example, under-researched. There wasn't a lot of interest in equities as an asset class. And therefore, you could make information, and sometimes there was also information arbitrage available which could be leveraged. Over a period of time, that has gone away. And therefore, naturally, growth slows down. For companies which have earnings as well, and that in our experience is the largest dictator of what happens to stock markets, their earnings growth also slows down over a period of time because they don't have the same ability to price their products, maintain margins, etc. And very often you will be forced to compete in the marketplace at lower margins because you cannot afford to let the market share go away. So it's very, very critical to know that this is typically what tends to happen. And then on top of that, you could have external shocks. So whatever you might say about the domestic economy, there is still dependency on the outside world. Maybe it's for capital, maybe it's for technology, maybe it's for certain brands that you sort of, as a consumer in that economy are dependent on. So there is a whole bunch of things that are there, and of course there is oil, which India continues to be dependent on. So we need to keep in mind is that these external shocks sit on top of the slowdown on earnings and growth that is natural over a period of time. And therefore your expectation of returns should normally be that they will continue to taper down over a period of time rather than go up, unless valuations become disproportionately low.
Sure, thanks. I'm sure investors now understand this concept a lot better. So let's shift the gears a bit and talk about the only thing that's constant in markets, that's uncertainty. So from policy shifts to the global events that we ourselves find as right now in. So these shifts and these events tend to become very unsettling for investors. So we often have questions asking, how can investors not get derailed from their long-term plan, their long-term goals during such uncertainties and volatile times?
So I think one of the first things that needs to happen when you're dealing with financial markets is that uncertainty is a given. I think that's a mental frame of mind. I think when we read in the media or hear it somewhere saying that times are uncertain, and obviously we live in a world where there are constantly tariff wars happening, geopolitical risks, etc. It feels like it's accentuated, but in general you will always find that equity markets or financial markets are subject to multiple levels of uncertainty, and therefore what we need to accept is that that is going to be a part and parcel of investing. The sooner we accept that it is normal, the more likely that we are able to deal with it better. A part of how you deal with this is to try to make your portfolio very resilient and also make your own responses to market conditions very resilient. So sometimes what might happen is through a multi-asset class portfolio, let's say having gold, equity, bonds, real estate, within equities, domestic, international equity, you can build portfolio resilience. But even then, you might find at certain times that many elements of that portfolio fall together. And at that time, the resilience that works is your own mental resilience, saying that I was not investing for 3 months, 6 months, 1 month, etc. Obviously, it doesn't feel good when I open an app. I go online, I look at data, and find my portfolio is down. But if I don't need the money, does it really need me to react and respond to it? And is it actually creating an opportunity for me to invest more rather than exiting that money? And I think that's where having clarity on some of these kind of items is very valuable, because a lot of this, like I said, is we can often be our best friends, and we can often be our worst enemies ourselves.
Sure, great. So let's move to another common question that investors ask is it possible to time the markets given especially the markets that we are in right now would seem to be a bit overvalued. So can investors really time the market going ahead?
So I think the answer is both yes and no. I think they can time it to the extent of being able to see that things are overpriced and overvalued, and therefore I need to be a little careful about how much more money I allocate there, or I need to pull out a little bit of money from there. So let's say, for example, if equities, both domestic and international, seem overvalued, you might decide that you want to pull out some money from there. But overvaluation by itself, or a price earnings multiple being high by itself, is not normally an indicator that markets will correct to 1 point, because that overvaluation could stay for a very long period of time. And vice versa, when markets become cheap as well, when you have undervaluation, there is no evidence to say that the moment undervaluation gets reached, you will see markets go off from there. And therefore, what we've learned over the years is that what you can do is, first of all, not get two things right, which is you got to time your exit and you got to time your entry back right during overvaluation, undervaluation.
Yes.
It's virtually impossible to do both. And if you miss some of the best days of investing, you end up losing a lot of the compounding benefits that come from equities, because as an asset class, it is defined and based on non-linear performance. So it's not necessarily that every day the markets behave in the same manner. At the same time, you also have the issue around how do you deal with an exit where the price has gone up and you've exited at a lower price, because it becomes very hard to buy until that asset goes back to the earlier price, because there's an anchoring bias that comes in, and you tend to sort of link yourself to that particular point, and therefore it's very hard to also run it that way. Thus, I think our experience has been that when you want to deal with these situations, you should first of all, before you get into investing itself, have a clear strategic asset allocation in place, saying that I need so much money in growth assets, so much in defensive assets. When an asset becomes overpriced, let's say growth assets become overvalued, pull out some money from there and move it to the defensive asset. If it becomes too overvalued, maybe you pull out a little bit more and move it to the defensive asset. But don't try to swing to the extremes, because if you look at data, players who tend to pull to the extremes, which are, for example, hedge funds, have historically been places where investors have not really made money. And therefore, the most renowned names and the best investment managers globally struggle with being able to get entry out and entry in to an asset class, right? And therefore, it's a very low probability event that you'll be successful.
Sure, great points put forth. So let's jump to some practical points and some rules that investors can follow. So given all the points that we've talked about, what is the best investment advice that you can give to today's investors in times of overvaluations, uncertainties, and the past experience that they've already have? What would you say to them?
So I think there are a few things that I would suggest. Number one is, ensure that you have multiple asset classes in your portfolio. There needs to be a mix of different asset classes. So when I say asset classes, I mean equity, debt, real estate, gold. Have them be geographically diversified. Don't stick to one geography only, because sometimes events can impact one particular geography much more than another geography. Number two is ensure that your expectations are realistic. I think do not believe that if you create realistic return expectations, you are being conservative. You're probably being real in terms of what might happen over long periods of time, even though you might be unreal when you look at it in very short pieces of data. Number three is you need to stay disciplined through SIPs and STPs. I think one of the beliefs is that if you're a high net worth investor, uh, SIPs are not the right choice for you. That's a retail vehicle. Our view is that the difficulty in timing markets is very much evident across all types of investors. Retail, high net worth, institutional, everyone suffers from the same challenge. And therefore an SIP strategy is as valuable to a high net worth investor as it is to a retail investor.
Right.
What it does is it removes some element of timing, and then you use top-ups through a form of lump sums whenever it comes up, when you see that there's a very compelling opportunity in a particular asset class. Number four is to look at your portfolio regularly, and when I say regularly, once a quarter is good, and rebalance if needed. I think over rebalancing portfolios also creates a lot of cost which can work against you. You have taxes, you could have exit costs, buying costs, etc. And therefore do not be overactive in your portfolio, but at the same time it's not really one of those fill it, shut it, forget it kind of models where you can let your portfolio just be there and not look at it for 10 years or 20 years and still be okay. Last but not the least, do stress test your portfolios for downturns. What you should assume is that every 5 to 10 years there will be some downturn which will be severe. And when it is severe, if you haven't stress tested your portfolio, you will tend to very often overreact because you've not imagined what that value of your portfolio would look like in terms of when there is a downturn. And what happens is, when you've not done that stress testing, it creates stress at the time of the actual event taking place. So clearly, stress testing a portfolio in good times, in our experience, works very well. It makes you think through what is it that you are likely to do if that event happens, and it then makes your response far more balanced if and when that event actually takes place.
Sure. Thank you for this great advice, Vishal. And just to sum up what we have discussed in today's episode, so investors must diversify, stick to their investment plan, and set realistic goals, set realistic expectations. They should also be aware of when they need funds and then they can plan accordingly. Also, as Vishal mentioned, this kind of holistic approach really helps investors to manage their risks and as well take the long-term opportunities, take advantages of those. So that was a very nice session. Thank you so much for sharing your learnings and your insights with us. Thank you, Vishal.
Thank you very much.
Thanks, and to our investors, thank you for tuning in. Remember to stay disciplined and keep investing wisely. Don't forget to subscribe to our YouTube channel for more such engaging content. Until next time, thank you.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BUSL and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory. This material is for information and educational purposes only.